After this scenario, you're at a dinner party with old friends. The waiter just cleared the plates and someone mentions the stock market's latest dip. You shrug and say, "It's just noise. My plan's built for decades." You don't flinch. Later, a friend is venting about his crushing car payment, and you just listen, sipping your drink, not joining in with your own money stress. A talk about the value of your time. How you turned down a freelance project to keep your weekends free. People watch you. They see your calm, your lack of urgency, the way you seem untouched by the financial anxieties buzzing around the table. They leave that night whispering, "Man, he must be doing really well." But what if I told you that your bank account, at that exact moment, had less in it than the guy complaining about his car payment? What if I told you that your investment plan was just a single automated transfer into a low-cost index fund you never check? What if I told you that this perceived wealth had almost nothing to do with money and everything to do with a set of signals our brains are biologically programmed to misinterpret? This isn't just a social misconception. This is the central illusion of modern finance, that financial calm is a result of wealth, not its cause. My name is Bobby, and I spend way too much time thinking about the behavioral signals of money. If you're someone who feels financially insecure but has been told you seem like you're doing great, or if you've ever looked at someone who seems effortlessly calm about money and felt a pang of "I'll never get there," or if you've ever wondered why your friend with the bigger paycheck seems more stressed about cash than you do, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't talking about getting rich, we are talking about seeming rich. We're talking about the invisible currency of calm, confidence, and control, and why mastering it is the most potent financial strategy you aren't using. There's the thing about perceived wealth. Conventional wisdom, the entire self-help industry, tells you to fake it till you make it. They tell you to dress for the job you want, drive the car of the person you want to be, to project success until it becomes real. But head advice ignores a fundamental, brutal truth. Faking it is incredibly expensive. It burns the very capital you need to build real security. The behaviors we associate with the wealthy aren't a costume you buy. They are the operating system you install. A system runs on a different fuel. It runs on patience, clarity, and a profound indifference to the approval of strangers. Let's anchor this in something solid, in the cold, hard science of perception. In 2010, psychologists Michael Norton and Dan Ariely published a landmark study. They asked thousands of Americans to estimate how wealth was distributed in the United States. They also asked them to describe their ideal distribution. The findings were shocking on two levels. First, people dramatically underestimated the actual staggering level of inequality. But second, and more importantly for us, their ideal distribution was far more equal than even their underestimated guesses. What this revealed was a deep disconnect. Our psychological picture of fair or normal wealth has no connection to the dollar-based reality, behavior adjustment, completely unanchored from actual account balances. Now fast forward to the work on embodied cognition. Research from scholars like Amy Cuddy at Harvard, though debated in its specifics, pointed to a powerful core idea: our physical behavior can change our biochemical state. Adopting postures of confidence, open, expansive, calm, can alter cortisol and testosterone levels, reducing stress and increasing a sense of control. Your body doesn't just express your state of mind, it can help create it. The person who acts calm begins to feel more in control, which fundamentally alters their financial decision-making landscape. Then, consider a 2018 paper in the Journal of Consumer Psychology on what they called the patience premium. Researchers found that in experiments, individuals who displayed greater patience, who chose a larger later reward over a smaller immediate one, were consistently rated by observers as more financially successful. This was true even when the actual stated incomes of the patient and impatient person were identical. The signal of patience itself created the perception of wealth. Synthesize these findings, and you get the academic blueprint. Perceived financial security is a cocktail mixed from an accurate, unpanicked view of reality, a biochemical state of lowered stress, and the visible, observable signal of patience. Your brain sees these signals and takes a shortcut. This person is not in immediate survival danger. They must have resources. Now, you might be thinking, okay, Bobby, that's a nice story about research papers, but how does that apply to my actual life in 2025? Well, look around you. This dynamic is everywhere. Let's take a detailed example, the car dealership. You need a reliable car. The conventional approach is filled with anxiety. You research for weeks, you feel the pressure, you walk in worried about your credit score and focused on the monthly payment. The person projecting the affluence aura does something different. They secure financing from their credit union before they walk in. They know the exact invoice price of the car. They walk in calm, they're not in a hurry. The salesperson comes over, pitches the monthly payment. This person doesn't take the bait. They say, "I'm interested in the out-the-door price." The salesperson brings the manager. There's pressure. There's talk of this deal today only. The calm person waits. They're not anxious. The trap here is that the entire dealership system is engineered to exploit time pressure and payment fixation. Your anxiety is their profit engine. The real cost? The anxious buyer, hyper-focused on fitting a $399 monthly payment, signs for a $32,000 car at a 7% APR, rolling in fees they didn't understand. The calm buyer, focused on the $28,500 out-the-door price and their pre-approval at 4%, doesn't just save $3,500 on the principal, they save thousands more in interest over the life of the loan. Save. Car, same need, wildly different financial outcome, and a wildly different perception in that dealership. For a medium example, consider the dinner check behavior. It arrives, the rich-seeming person doesn't flinch. They don't audit it for who had the extra glass of wine. They might even say, "I've got this one." The perception is generosity, abundance. The reality is that they budgeted $80 for social dining this month. This was a planned, controlled expense, not a reactive, stressful event. Behavior, the anxious person calculating furiously signals scarcity, even if they have more money in the bank. Quick examples: not checking your investment portfolio daily, using complicated jargon to sound smart, saying, "I don't know" when asked about the latest crypto trend, choosing the free Saturday morning over time and a half over time. This is what we call asterisk, the calm premium asterisk. It's the tangible financial and social advantage granted to those who project controlled patience. Let's perform a brutal audit of the calm premium asterisk. Alex earns a solid $75,000 a year. We're going to track anxious Alex versus calm Alex over a single decade. Alex starts with a gross income of $75,000 per year, but over 10 years, that's $750,000. That's the number everyone sees. First, there's the impulse tax. Anxious, scarcity-driven decisions lead to overpaying for convenience and seeking retail therapy for stress. Anxious Alex spends an extra $120 a month on last-minute takeout, $65 a month on subscription leaks he forgot about, and $200 a month on treat-yourself purchases to feel in control. That's $385 a month. That's $4,620 a year. The running total over 10 years is now $750,000 minus $46,200. So we're at $738. But that's the easy math. We all know that. Now we have to subtract the panic penalty, the investment returns. Anxious Alex checks his portfolio constantly. He reacts to headlines, sells during dips out of fear, and chases the latest hot stock tip. His average annual return after all this frantic activity is a pitiful 5%. Calm Alex uses auto contributions into a low-cost index fund and ignores the noise. Her return is a steady 8%. Let's assume they both invest $10,000 a year. Behavior after 10 years at 5%, Anxious Alex's portfolio grows to about $132,067. At 8%, Calm Alex's grows to $156,455. That's a difference of $24,388 in lost compounding. Our total is now $703,800 minus $24,388. We're at $679,412, but we're not done. Then there's the opportunity cost of scarcity time. Anxious Alex spends 5 hours a week worrying about money, researching get-rich-quick schemes, and juggling bills. That's 260 hours a year. Calm Alex spends 2 hours a month on her automated finances. That's 24 hours a year. The difference is 236 hours a year. Valuing that time at just Alex's hourly wage of about $36, that's $8,496 a year of mental bandwidth burned. Over 10 years, that's $84,960. New total, $679,412 minus $84,960 equals $594,450 out, and it gets worse. Then there's the darkest category, the psychological interest rate. Chronic financial anxiety leads to poorer health, higher medical costs, and lower professional performance. You don't negotiate raises, you avoid career risks. Studies peg this hidden drag on earnings at a conservative 5%. That's a $3,750 annual drag on a $75,000 salary. Over 10 years, that's another $37,500 gone. So let's add it up. Starting decade income, $750,000 minus the impulse tax of $46,200 minus the panic penalty of $24,388 minus the scarcity time cost of $84,960 minus the psychological interest of $37,500. Anxious Alex's effective wealth is $556,952. Calm Alex with the exact same salary avoids these traps. The calm premium isn't just saved costs, it's the inverse. That's $193,048 effectively created from thin air through behavior alone. That's not a typo. $750,000 in earnings actually became just over $556,000 in effective wealth for the anxious person. Think about that for a second. You can incinerate nearly $200,000 of your life's energy, not by being lazy, but by being nervous. And we haven't even touched on the broader data. According to the Federal Reserve's 2023 survey of household economics and decision-making, 37% of American adults would need to borrow or sell something to cover a $400. A significant portion of those same individuals are engaged in constant discretionary spending to signal normalcy. 2024 CNBC Financial Confidence Survey found that 61% of people living paycheck to paycheck report high anxiety about money, but only 29% of those with a simple written budget do, and this held true across income levels. Means the feeling of control is more tied to your system than your salary. And before you say, but Bobby, calm is a luxury for people who already have money, consider this counter data. A 22 study in the Journal of Financial Planning found that individuals who practice mental accounting, treating money in dedicated buckets for bills, fun, and savings, reported feeling 43% more in control of their finances than those with higher incomes, but a lump sum, chaotic approach. That the behavior created the feeling, which then enabled better decisions. That's the equivalent of giving yourself a $10,000 raise in peace of mind without earning an extra dime. This is where it gets really interesting. When you feel financially insecure and anxious, you seek a quick hit of control or status to feel better. That hit is often a purchase, a new gadget, a nicer dinner out, a car upgrade, variable behavior resources, moving your actual financial position backward. That backward movement then heightens your sense of insecurity, which makes you even more anxious, sending you back to seek another quick hit. Behavior. It's like being desperately thirsty and drinking salt water. The immediate sensation seems to solve the problem, but it actively, chemically makes the real problem worse. Everything seems fine until you're terminally dehydrated. And here's what really gets me. The attention economy and the consumer credit industry rely on your anxiety. Count on you feeling out of control, so you'll scroll endlessly for solutions, which are just ads. They depend on you seeking the signal of wealth, the luxury good, the new car, to medicate that feeling. They literally budget for your impulsive, emotionally driven mistake at 25% APR. When you start cultivating genuine calm, when you implement a budget, when you stop checking prices and start checking your values, you become a bad customer for them. You don't click the ads. You don't finance your lifestyle. You're a terrible source of profit. But you become the best CFO your own life will ever have. These industries want you focused on the appearance of wealth. The watch, the car, the Instagram vacation, because that obsession hides the mechanics of wealth. Automation, patience, and compound interest. This isn't just bad psychology or bad math. This is predatory. This is designed. This is a scam. Now, I can hear the objections already. Bobby, this is just telling poor people to act calm while they drown. It's victim blaming. And look, I get it. That seems insultingly simplistic, but the data shows the sequence matters. The behaviors often create the buffer, not the other way around. The first step out of anxiety isn't have more money, it's create more clarity. It's spending 1 hour on a Sunday writing down every single dollar from the past week. That act of observation costs $0, and it creates the first molecule of control. You might also be thinking, but rich people are calm because they have safety nets. And sure, some are, but many built the safety net through these very behaviors, and many who inherited wealth are profoundly anxious about losing it. The correlation is messy. The causal power of patient, clear behavior is clean, and it's accessible to anyone, right now. The problem isn't your bank account balance today. It's the behavioral cycle that keeps that balance from growing tomorrow. Break the cycle, and the balance follows. So what do you actually do with this information? How do you escape the trap and start collecting the calm premium for yourself? Let me give you something practical. Strategy number 1, the Sunday night clarity audit. This is a non-negotiable 30-minute ritual you do every single week. You open every financial account, checking, savings, credit cards, and you simply look down the ending balance of each. You then go through every single transaction from the past week and you categorize it in a simple note on your phone. Need, want, or oops. Behavior, no judgment, just curiosity. Why it works is because it separates the feeling of anxiety from the facts of your situation. You can't manage a blur. Block 30 minutes on your Sunday night. Open the apps, use a simple notes app or a piece of paper. The categories are just 3. Need, groceries, true essentials. Want, coffee out, streaming, new shoes. And oops, that impulse buy you immediately regretted. Behavior. Then ask one question. Does this spending align with what I actually care about? Not, is this good or bad? For example, you see $120 on coffee shops. Instead of guilt, you ask, did those 12 coffees bring me $120 worth of joy, connection, or energy, or was I just on autopilot? The honest answer dictates your choice next week. Behavior, that's control. Strategy number 2, the peace of mind account. This is a separate savings account whose only job is to buy you psychological safety. It's physical proof you're handling things. Open a new, no-fee savings account at a different bank than your main one. Name it Buffer or Sleepwell. Set up an auto transfer of $20, $50, whatever you won't miss, every single paycheck. The account is not for emergencies. Its sole purpose is to sit there. When financial anxiety hits, a scary headline, an unexpected bill, you open that app and look at the number. Here you've given your calm a dollar figure. Strategy number 3, the feeling versus thing filter. Before any non-essential purchase over $50, you pause and ask a scripted question. Am I buying this thing or am I buying the feeling I think it will give me? Are you buying status, control, relief from boredom? If it's a feeling, your next question is, what's a free or cheap way I could get 80% of that feeling right now? Want that new $1,200 laptop to feel professional and up to date? Try deep cleaning your current laptop, organizing your digital files, and spending an hour on a free skill-building course online. You get the feeling of control and progress for $0, but the biggest shift is psychological. You have to start asking, does this move me toward the person I want to be? Instead of, can I afford this? You're not your net worth. You're your recovery speed. How quickly can you get back to baseline calm after a financial setback? That's the true metric. Here's what I want you to do this weekend. Block 60 minutes. Perform your first Sunday night clarity audit on last month's spending. Then, open that peace of mind account. Deposit $1 if that's all you can do. What you'll discover in that hour is that the simple, brave act of looking at the numbers creates more tangible calm than months of avoiding them. I want to leave you with one final thought. This pursuit, this calm premium, isn't really about money. It's about sovereignty. It's about reclaiming your attention, your time, and your emotional state from a system that profits by stealing them. We thought financial security was a math problem to solve with more income. But the reality is, it's a psychological fortress to build with better habits. Our grandparents often had pensions and external guaranteed promise of survival certainty. We traded that for 401k and the gig economy, placing the entire burden of generating that certainty internally on our own behavior and our own minds. Aber, the people who actually thrive today aren't the ones with the most exotic investments or the highest salaries. They're the ones who have decoupled their sense of safety from the daily gyrations of the market and their checking account. They've internalized the certainty you can't control the global economy, your company's layoff decisions, or inflation. But you can control your rituals, your attention, and your responses. You can manufacture the single most valuable asset in a chaotic world, unflappability. And in an economy screaming for your panic, unflappability is the ultimate superpower. Makes people whisper. Are they rich? And soon enough, because of the behaviors that unflappability enables, the answer becomes yes. You're not broken for feeling anxious about money. You're human in a machine designed to create that anxiety. This journey is unfair because you have to build your own calm in a storm that others are paid to intensify by a behavior. But once you understand that the affluence aura, that mysterious calm, is just a set of learnable behaviors, the calm premium, you can start collecting it for yourself. Dollar by dollar, breath by breath. If this video reframed what rich means for you, share it with a friend who seems anxious about money, or the one who seems strangely, enviably calm. Smash that like button and hit subscribe for more content that challenges how you think about building a real life, not just a balance sheet. Thanks for watching, and I'll see you in the next one.